Hi, everybody. Welcome to the 7 and 7 show. I'm Zach Ellison, your host. And in this show, we always talk to the best CIOs and wealth managers across the country. Today, I'm very excited to have Chris Osmond, who is the CIO of Centura Wealth Advisory based in San Diego. And Chris is also a fellow CFA and CIO charter holder and graduate of undergrad in 2004, which is also when I graduated. So we consider that a very good vintage year in the history of wealth advisory. So, Chris, awesome having you here today. I'm really excited to talk to you about your views on the markets and investing. Before we dig into the 7 questions, if you could just tell us a little bit about your background and how you got here, that'd be great.
Yeah, no, thanks, Zach. Great to be here. Really appreciate it. Happy to be a guest. So, my background, as you said, graduated 2004. I was a little bit odd duck. Kind of knew what I wanted to do since I was a little kid. My grandfather gave me IBM stock when I was born. And I found out about it when I was 8 or 9. And I just remember thinking that was like the coolest thing, right? I'm the owner of this worldwide company. And of course, now I know 10 shares means nothing. But at the time, I just thought that was so cool. And I remember grabbing the business section. I couldn't understand but like every 10th word, whatever. But that just kind of forced my passion for investing. And ultimately, that's why I chose my undergrad, because of their investment management program. And then I just know I wanted to manage money. So I spent the first 2/3 of my career in private banks, in their wealth management, constructing custom investment portfolios for high net worth individuals, foundations, endowments, corporations, things of that nature. And I spent the last third of my career in the RIA world, where I served as a chief investment officer for a Kansas City-based RIA, joined at $3.5 billion. Departed then just under $18 billion. Over that time, really grew out their investment platform, both on the public as well as the private side. And now I'm the chief investment officer at Centura Wealth Advisory.
That's amazing. Your background's really impressive. And, I'm curious, what made you want to focus on wealth advisors and leave the huge firms that you worked at previously?
Well, not to talk bad about banks, right? But a lot of times they tend to manage the lowest common denominator, and oftentimes I found myself, telling clients or giving them this custom portfolio when in reality it's mandates sent from above, right? And if I deviate so far from large cap core relative to the target allocation, I get slapped on the wrist or have to explain why am I overweight? And I'm like, is this really in the best interest of the client? And oftentimes I had this kind of push-pull reaction and just didn't always feel right. So I was looking to have more autonomy and the ability to really build a platform that service the clients in their best interest, gave them the tools and resources that they needed to help achieve their objectives. And I found I've really enjoyed working with advisors themselves to help implement those strategies.
It seems to me like there's a lot more that you can do as a wealth advisor in a smaller firm, albeit still large, but smaller than the mega shops, where you can have a more customized approach and really get closer to your clients and really meet their needs in a way that you probably couldn't in a mega institution. Which leads into the first question of the day, the first of the 7, which is, what can wealth advisors do, in your view, to provide differentiated value for their clients? And you already touched on a little bit, but I'd love to hear more.
Yeah, so at Centura, we're like every RIA, we lead with planning, right? But I would say what's different in how we lead with planning is when we look at other RIAs, they tend to focus on what we call below the line planning. So that's doing cash flow planning, goals-based planning, maybe some asset location, then they're going to wrap a pretty little bow on it and do some Monte Carlo analysis, right? We do that too. It's all very valuable, but we feel that value is really marginal at best. And unless you do the work above the line, it doesn't really, move the needle for our clients. So we focus above the line and we do income tax planning, very sophisticated, complex income tax planning, whereby we've been able to reduce or defer anywhere from 20 to 80% of someone's tax liability in a given year, depending on their fact pattern. So pretty remarkable stuff. And then we do a lot of wealth transfer planning and then balance sheet optimization. We feel once we do that work, then we can do that other stuff. And that's how we really drive value. And then additionally, taking that output from the planning and driving the investment portfolio construction, and whereby we adopt more of an endowment model. So we subscribe to using a heavy dose of alternatives and private market investments.
And yeah, your focus on alternatives that we've talked about offline, I think is a big differentiator on the investment side, along with all the other stuff that you're doing. What are some core investment principles that you live by in general?
Man, I've got a few. I'd say first off, that emotion is the root of all investment decision making evil. And so it needs to be removed at all costs from the equation. And I found the best way to remove emotion is to create a process and follow the process. And do not invest in something unless you fully understand it. And that means the mechanics, the opportunity, the terms, the risks. I think often what is under appreciated is the risks of an investment and really fully understanding what those risks are. And once you understand all that, do your research, do your due diligence. And I've also found that a quick DQ or disqualification is oftentimes just as valuable as actually moving forward with an investment. And then I'd say lastly, follow your gut. I mean, and I know that kind of almost is conflicting with don't let emotion, into the decision-making process. But oftentimes if something doesn't smell right, it probably isn't. So follow that gut instinct and listen to yourself.
Yeah, when you were saying that, my first thought was the sniff test, right? In the sense that you're not investing with emotion, but you're saying, hey, something's not right here. It's almost like a downside check more so than the upside, right? I mean, you can get excited about shiny objects and high flying potential investments, but I think it's where the behavioral aspects really come into play is on the downside, where your subconscious sometimes knows something's not right here. And the key for me, at least, and it is to really avoid investments that have yellow flags, because afterwards, if things do go wrong, you're kicking yourself because you knew they were there, but you'd ignored them. And so that's, I think a lot about behavioral finance, which you do as well. And it's amazing to me how many people buy the highs and sell the lows. I mean, and it's like every time there's a downturn in the market or a crisis, we learn lessons from it. And we say, well, next time we're not going to do that. And then it happens. We do the exact same thing over and over again. I mean, it's unbelievable to me. I mean, right now, there's some really interesting opportunities in the market that we can talk about, and people are pretty scared, I think. And so they're missing a lot of good opportunities. And quite frankly, if there's a big recession and then a big sell-off in the markets, I think you're going to see that history repeat itself. And there's going to be folks that are like, hey, I'm just going to go to treasuries right now when they should be buying. And then when they should be selling, and the things are like in 2021, all they want to do is buy more when they should have been taking profits, right? So it's crazy to me. I mean, so I think what you're doing is you're providing, amongst other things, a sanity check for your investors as well, to say, hey, look, don't let your emotions sway you. Obviously, do trust your gut, like you said. Do make sure it passed the sniff test, but don't get carried away with emotions, right? Stick to a process that has worked consistently. It's not always going to be right or always get you the perfect outcome, but over time, if you stick with it, you'll get the results that you're looking for.
Right. And I'd say continue to evolve your process too, right? Because you do learn from hopefully you learn from your mistakes. and then when you do, right, you go back and adjust the process to account for those mistakes. So hopefully next time when you're faced with that same decision, it's an easy bypass, right?
Yeah. And that leads into my next question, which was going to be about risks and learning from mistakes and things that keep you up at night. So the question is, what are some risks that are forming now that clients should be aware of that maybe they're missing?
Right. I think you hear on the news, nonstop every day right now, just the bank financial stability. Well, there's a lot of emphasis put on deposits and liquidity and so forth, but we're not hearing a ton about what is happening within the commercial real estate portfolio books, and the lending portfolio books within banks, and to me, there is a huge potential bubble looming. You look at office real estate and specifically, and $46 billion is going to mature in floating rate. commercial office space debt this year. And vacancies at 18% and only increase. Look at San Diego, where we're headquartered in downtown, vacancy is up to 35%. And Chicago is approaching 45. You start looking, is this a longer secular trend that's forming in that from this work at home, atmosphere now, work environment now, is office real estate going to be ever what it was once, ever be what it once was? And to me, that's a really big risk that's not getting a lot of press right now or a lot of attention, is this potential bubble in office real estate, as well as that contagious effect that it could have on then retail, because if there's no one coming down to work downtown, there's no one buying and shopping downtown. There's less people dining downtown. So what impact does that have on other sectors and industries within the real estate, that may be impacted from contagion?
I think that's a great risk factor to point out. I'm in the same boat in that I think commercial real estate's going to be in for a horrendous ride. And people don't realize it yet because a lot of these leases are long-term and they haven't run off yet. But to your point, Chris, people aren't going back to the office 5 days a week, probably for the rest of our lifetimes or ever. It's not going to happen. The world's changed. The paradigm has shifted, and you might see people in the office 3 to 4 days a week. But what that means is, mathematically, if they're in the office 3 days a week, that means you need 60% of the space, roughly, right?
Right.
It's 40% vacancy, which means that building is not going to be nearly as valuable. And
Right.
I made a great point on the correlation to other areas of the economy, like retail spending. I mean, it's all correlated. When you're losing money in one area, it affects how you think about other areas, and it affects what you do in those other areas. And it's, I think there's a general trend towards risk on, risk off type thinking. Bullish, bearish, greedy, fearful. It's all synonyms for the same stuff. But ultimately, right now, I think we're still in a very positive mindset, which I don't understand. I'm very bearish. I think the markets are hammered. Do you agree?
Well, I mean, I think what's interesting, I think this is probably the most telegraphed recession ever, right? Yeah. This is the most anticipated recession ever. But yeah, the NASDAQ 100 is in a bull market. Like, what is going on? It's almost irrational exuberance, and I get the market's forward looking, but to me, there's so many tail risks out there right now that if one shoe were to drop, they all could drop, right? I mean, commercial real estate's one. I think there's a potential consumer credit bubble that's forming, on the heels of COVID. All the, a family of four got about $20,000 in their pocket, right, from the government. So they paid down debt. So like these subprime borrowers got this artificial bump to their credit score. And then these algorithmic lenders, buy now, pay later lenders are just giving out credit. Well, all that rate's floating rate, right? And I just saw last week the rate on credit cards are at all-time highs because it is floating rate, right? And if the Fed is successful at increasing the pain of the labor market and we start to see unemployment tick up, that bodes well. I mean, that does not bode well for the consumer, right? So I just feel there's a lot of tail risks out there that, yeah, I'm nervous. I'm a hopeful optimist, right? But I'm also a realist, and I feel there's a lot of tail risks out there that, yeah, do keep me up at night, and that if they happen, could be very troublesome.
100% agree. I think people are irrationally exuberant right now, given where we're at. I mean, there's so many things that could go wrong and that I think probably will go wrong, and very little that I see as an upside catalyst. And yet the market keeps going up, which means it's a farther to fall, right? I mean, the higher it goes, the farther to fall. So yeah, I'm in the same boat, which is a nice segue to the next question, which is, given that public stocks and bonds are probably likely to underperform, you have to do something with dollars. And so alternative investments have become really the place to go for smart money. And you're one of the leaders in this space and being thoughtful about investments outside of traditional stocks and bonds. So talk broadly about why alternative investments are attractive and what they do to help optimize a portfolio.
Yeah, no, absolutely. Of course, I think there's always the scholastic response, right? In that, if you, in order to push that efficient frontier up and to the left, You need to incorporate new asset classes, and what better asset classes to do that, or most effective asset classes than alternatives or private markets, given their lower correlations to public markets. Right? So there's that response, the immediate benefit from a increased risk-adjusted return or optimal portfolio. You're getting more juice for your squeeze, right? um, but I think also when you look at the value you can add in a 60-40 portfolio, I mean, let's be honest, it's marginal. You're either doing 100% passive, or if you're trying to pick active managers and inefficient public market asset classes, the manager dispersion is razor thin. You could pick the best public mid-cap growth manager, and you're probably not going to get rewarded too much greater than if you pick the worst, right? However, you go into a private market asset class, and that dispersion, you can drive a Mack truck through. And so you're rewarded for finding top quartile and decile managers, but you're also equally as punished if you don't pick good ones. And I think that just asymmetric return profile, it can really pay benefits to the overall portfolio construction. And that's where we tend to focus. We try to add more value by thinking outside of public markets. I think also just the pure opportunity set, right? You probably remember, Zach, like when the Wilshire 5000 was 5,000 stocks, right? Now it's less than 4,000. So you're seeing companies not as many public companies. The opportunity set to outperform is much less. You're seeing companies go private, stay private longer. Of private companies, right? There's over 80,000 U.S. private companies, less than 4,000 public. I like the opportunity set, try and find inefficiencies in 80,000 versus 4,000, and then trying to provide alpha, and everyone might say, well, they're smaller. Well, that's not necessarily true, because of companies over 100 million in revenue, 83% are private, 17 are public. Again, so when we're looking at trying to add alpha, trying to find inefficiencies in various asset classes, we feel that opportunity set is much greater in alternatives. And that's how we're going to deliver a superior risk-adjusted return profile. And if we want to minimize peak to trough drawdown, that's how we're going to do it. We're going to do it through inclusion of alts.
So what are your favorite alts right now?
So if I had to pick two favorite asset classes, and this was before you asked me to come on the show. So full disclosure, it's secondaries and venture debt. I mean, hands down. I mean, I look at secondaries and, one, you have the denominator effect, right? Because public markets got destroyed by private markets last year. So they're over allocated. So institutional investors going in, trimming exposure to alts, needing liquidity. You have a lot of disruption and dislocation forming, that there's going to be a significant demand for liquidity. And so you're going to have a lot of LPs just, banging at the door to get out. So a lot of opportunities in the secondary market, in my opinion, not just private equity. I think in private debt, I think in private real estate, perhaps private real estate even more so. There could be a lot of great secondary opportunities that we look back and say 2023, 2024 vintages, probably some of the best in a long time. And then, looking at venture debt, I mean, one, in general, I'm a fan of venture debt. I love the income production, getting double-digit income, the consistency of that income production, and then also the ability for some upside through the investment of, getting granted warrants and things of that nature, typically better covenant packages and things like that. But today, I really like the opportunity set, just given the biggest venture debt lender is gone, right? Silicon Valley Bank, they're out. And then you also look at banks' willingness to lend to private companies. Well, that's going to be diminished. And then you factor in potential regulation coming down. That's also going to further, diminish their ability to lend to private companies. Someone's got to fill that gap. So it's going to be private lenders. I like that. And then additionally, given the valuation adjustments we're seeing in venture capital and growth equity right now, it creates a much lower valuation to come into the door at. You're getting bigger warrant packages and lower strike prices. So the IRR potential here, I mean, you probably know better than I would, but I mean, I'm putting well over 20% IRR expectations on venture debt right now. I think additionally, which I didn't mention, because there's so much demand, and you could probably speak to this more, Zach, but the ability to, increase the quality of loans and create a more covenant, heavy, loan package, right now it just feels also more beneficial for the venture debt lender.
Yeah, you nailed it. I mean, those are really the key points. And it was always a very good strategy, and in my opinion, one of the best in terms of risk adjusted returns. But to your point, when you have a market event like SVB as the largest supplier of venture debt in the space, basically being taken offline, it just creates an immense imbalance between demand for capital and supply. And just to put some quick numbers around it, over the last 3 years, from 2020 through the end of 2022, there was roughly 750 billion deployed by VCs into startups in the US. And there was about 100 billion of debt, maybe a little bit less, but so roughly we're talking about 850 billion of capital deployed over 3 years. And most of these companies come back to market to raise funds every 2 to 3 years as startups because they're reliant heavily on external financing. So you've got more demand for capital coming up in the back half of 23 and 2024, 2025, combined with this diminished supply, because the supply on the equity side is also lower because valuations are lower. So it's a lot more expensive for companies to raise equity capital. The check sizes are smaller and the deals are taking a lot longer to get done. So combine that difficulty on the equity fundraising side with half or more than half of the debt supply being taken offline, because to your point, it's not just SVB, it's other banks that are going to be pulling back, not because of anything having to do with venture debt, but because of just broader risk and heightened regulation. And so there's just this amazing mix of factors going on at the aggregate level where you've got super high demand and very low supply, which even folks that aren't sophisticated investors can understand that equation 101. So yeah, no, great points on that. And then I want to ask you also, what is there anything you're thinking about now that you think others are missing? Just something that's kind of off the radar. I mean, you brought up a couple things already.
Mm-hmm.
Is there anything else that we should be thinking about, but for some reason just not getting any press?
Man, I mean, and I know about that, but I think it also goes, but rather I would say I'd leave you with, it goes back to investment principle I didn't mention. And that is stay the course, don't make knee-jerk reactions. Like if you're going to make changes, make the change at the peripheral, right?
Yep.
And don't react to a event and sell out. It's impossible to time the market. That's why we say you can't time the market. It's not about timing the market, it's time in the market, right? So if anything, it's don't make knee-jerk reactions based off of one data point or multiple. Take a step back, try to see the forest through the trees. Sometimes easier said than done. And don't think, hey, what is going to happen in the next day, week, month, but rather, is this really going to be impactful over the next 3 to 5 years? And try to make your decisions based off of that. And again, marginal changes. It's not about, saying, oh, well, I'm a 60-40 portfolio, market's down 20, I'm going to sell everything. Well, no, it's, maybe that's time you want to get aggressive. I'm just kidding. But no, stay in the course and just, stay invested and, trust the partners that you work with.
Yeah, you brought up a point there that I think ties into some other things we were talking about earlier, which is the short-term nature of the public markets, I think leads to inefficient decisions because everybody's thinking on a quarterly basis. And I had this conversation just this week with somebody, and I said, one of the reasons I love private markets in general is because the capital in the private markets is much more long-term focused.
Mm-hmm.
A lot of funds are, 5-year funds, 7-year funds, 10-year funds, and people are thinking through cycles as opposed to thinking about what are we going to do in the next month so that our P&L is maximized so we can get paid. And ultimately, I've been on both sides of the fence, and that I used to be a bond trader and a portfolio manager of corporate bonds, and it was much more short-term focused, right? Especially trading. It's really like, what's your P&L? Yeah. And then in the private markets, though, I think there's a greater opportunity to outperform because you're not worried about today, you're worried about long-term performance. And so I think the quality of decisions is better in general. And it fits better into a portfolio management context, in a portfolio construction context when you're thinking longer term. And this fits in with your principle of being patient, making changes on the margin, but sticking with your core strategy.
Yep.
So that
And
resonates with me.
yeah, no, and I would add, and one thing, I forgot to add about the value of alternatives. I think that kind of goes on the behavioral aspect of investing. I think investing in alternatives also instills good investor behavior, right?
Mhm.
Because they can't get out, right? And then so they're forced to sit in and experience the ride, and they see that it's actually a smoother ride, and the results are better typically at the end. And so I feel that it naturally instills good investor behavior through investing in alternatives.
Yeah, it's so funny because people talk about investing in longer term closed end funds like a private equity fund or a private credit fund as almost being like married, essentially, right? And I was talking to somebody who's invested with us, and he told me half jokingly, I did more diligence on ARI than I did on my wife, right? In the sense that we're going to be locked together for a long time. It's easier to get a divorce than it is to part ways with a private manager. So there's to your point, there's just better decisions being made because, of many reasons, but one of them being that, you're going to be together for a long time. And when you find the right partners, I mean, it creates almost magical returns, right, over time, because you're seeing opportunities that others don't see. And you've got that track record of working together and that trust that you build that happens over years. And you never get that in the public markets because it's so transactional. It's all about what can you do for me now. It's very much a zero-sum game, in my opinion. Whereas longer-term private markets investing, to me, it's not a zero-sum game. It's really much of a synergy between the investor and the fund manager that helps both sides. So we're almost out of time. So I want to just ask the final question, which is, on a going forward basis over the next couple of years or through this next part of the cycle, what are the key themes that you're thinking about that investors should as well?
Yeah, no, I mean, I think, the obvious one, race to digitization, right? AI, our preference is to play that through the private equity markets. Feel that's where a lot of the innovation is taking place. Yes, the large mega cap public companies are investing in that, but they're also acquiring a lot of private companies that have already created this software and creating this innovation. So we tend to look to the private equity markets to really leverage that race of digitization, AI, and playing on that. I know that we mentioned a lot of risks forming in commercial real estate, but I think those same themes can also be leveraged on the commercial real estate side as you're looking at different supply demand imbalances. So, data centers, chip facilities, those that are going to be required as we shift more to AI and digitization, we need some sort of real estate. And I think one other one that doesn't get a lot of press actually in the real estate is cold storage. And there's a huge supply demand imbalance, probably more so than housing, that just doesn't get a lot of press. So that we tend to focus on that and look at real estate. And then I think obviously there's this climate shift, right, into, green and climate protection. So ways to capitalize on climate tech or agri-tech. So, technology for more clean agriculture and things of that nature.
So the cold storage that answered the question of something that you're thinking about that most others are. I rarely see people talking about that. And what's interesting is all the themes you talked about, venture debt touches, right? And so what's great about what we do is we get to look at the themes that we believe in and invest in those themes and be industry agnostic, but have the opportunity to invest in innovation as an asset class, but in a safer wrapper than you would as an equity investor. So that's kind of how I think about it. But those are great themes. And I'm so glad you came on today. I learned a lot, and I feel like I always learn stuff talking to you. And
Likewise.
very happy that you joined. And thanks everybody for listening to the 7 and 7 show. reach out to Chris Osmond at Centura Wealth Advisory out of San Diego. And hopefully you'll learn a lot in terms of what he can do for you and what the firm can do for you in alts and also in broader planning. So stay tuned for the next episode and see you soon.